Welcome everyone. As Teiko mentioned, this is the third and the last part of this webinar series on the IFRS Sustainability Disclosure Standards. My name is Yana Mudronova, and I am the SBFN Data and Disclosure Working Group Coordinator, and I will moderate today's session. This series is hosted by us, Sustainable Banking and Finance Network, and the IFRS Foundation. As a voluntary network of financial sector regulators and industry association hosted by IFC, we work with our 100 members in 72 countries to support sustainable finance in emerging markets. This webinar series is part of the long-standing collaboration with IFRS Foundation, focusing on capacity building, awareness, and knowledge products to encourage greater transparency and accountability. In this series specifically, we dive deeper into how jurisdictions and you, regulators, standard setters, and financial institutions can work together to adopt the IFRS Sustainability Disclosure Standards. In the last session, we focused on considerations for the regulatory process, so-called how, and reporting entities, who. Today, we will continue to discuss requirements and readiness. I am pleased to be joined by representatives of two jurisdictions, Turkey and Chile, namely Ms. Gulşah Günay of the Public Oversight Accounting and Auditing Standards Authority of Turkey, and Bernardita Piedrabuena of the Financial Market Commission of Chile. Our guests will be sharing their country experiences with adopting the IFRS standards. Both Turkey and Chile are member countries of SBFN, and we have been following and supporting the sustainable finance journey closely. I would like to extend our warm welcome and thank you for joining us today. And with this, I now want to hand over to the IFRS Foundation team, Jonathan Bravo and Mosireleti Mokokwane.
Thank you very much, Jana, for the introduction and the SBFN team. Let me start by noting it's been a pleasure to accompany you over the three webinars we've been hosting in the series, and I hope it's been useful so far. I'm also delighted that both Bernardita and Gulşah are joining us to share their experiences, jurisdictions that have already progressed, I think, on the adoption journey. And I think this will be really helpful for SBFN members to have those reference points. So with that, thank you very much, Mosi, for sharing the slides. Given we've had a couple of sessions, just wanted to do a bit of a recap of where we're coming from and where we are heading. If we can move to the next slide. Just for those that may not have had the opportunity to join, as Teiko mentioned, as a reminder, the two first sessions, I think, are available to you. But just to give you a bit of context, we were outlining how the work we're doing in terms of developing tools, resources, materials that are suitable for jurisdictions, how they come together with the work we're undertaking with our partners. IFC, SBFN is a key partner here, and how those tools are useful in the delivery of information suitable directly for jurisdictions, to different platforms, as well as for the MDBs. And all of that was grounded on the jurisdictional guide and some of the materials we will be touching on today. If we can move to the next slide, Mosi, please. Again, much of this work is grounded on the jurisdictional guide that was published in May 2024, again, with the objective to promote globally consistent and comparable sustainability-related disclosures for the capital market. So again, providing some parameters that are useful for jurisdictions in designing their plans, their roadmaps towards the adoption. And again, setting the parameters, the foundations, the features that will conform the profiles that we plan to publish in order to deliver transparency for the capital markets, for investors, for preparers, for regulators, as to what is the progress, global progress on adoption, and what are the particular features of jurisdictions, so that investors, preparers can understand what they can expect from the disclosures in these jurisdictions. We can move to the next slide. We covered in sessions 1 and 2 some of the features. These are really the grounding pillars under the Roadmap Development Tool, for which we will be covering 2 of the sections today on readiness and alignment. So we've touched on some of those in terms of the regulatory process, in terms of the reporting entities that have public accountability, and how jurisdictions can go with respect to the onboarding on those. If we can move to the next slide, Mosi. Just another reminder that the Roadmap Development Tool, which again It's the tool that we have developed to help jurisdictions translate some of the more theoretical concepts in the jurisdictional guide into a series of practical questions, how we've grouped all those features that I was showing before in the honeycomb slide according with the 4 pillars. So the regulatory process, the reporting entities, and what we will be covering today. So the Roadmap Development Tool structures all of those features, trying to help jurisdictions go through a thought process, trying to address what are the matter for considerations and the outcomes that they should be pursuing in order to meet their policy goals. We can move to the next slide. Just a reminder of what are the 7 different pathways that we had outlined in our jurisdictional guide, ranging from the early stages of the commitment to the adoption or other use of ISSB standards to what we hope will be the approach that many jurisdictions will be pursuing, that it's about fully adopting ISSB standards, because I think we believe that the best strategy to deliver the global consistency and comparability that we're looking for is moving towards that goal, towards that target. And we can probably benefit later on from the experiences that our colleagues from Chile and Turkey will be sharing with us. We can just move to the final slide before I think we get into the real content that we want to cover today. Just as an example, just to frame how you should be framing what you will be hearing from us today, we have developed templates for each of the pathways that I was covering before, each of the pathways that are included in the jurisdictional guide. Through those templates, jurisdictions, you as different stakeholders, market participants, you will be able to contrast the outcomes of the decisions that are being made by jurisdictions, how they will be described by the IFRS Foundation, and to what extent they will be moving towards fully adopting ISSB standards in order to deliver that comparability. So the tool is a practical, interactive resource that's available on the IFRS Foundation website that is suitable for implementation partners, that's suitable for jurisdictions, and that's suitable for interested stakeholders that will be getting involved in the jurisdictional process. So with that, let's move then into the first decision area that we're planning to cover today, which is a pretty critical one, which is actually what are the requirements that a jurisdiction should be considering in order to determine the sustainability-related disclosures that will be embedded into the jurisdictional framework. So a number of features are covered within this decision area in the Roadmap Development Tool, the degree of alignment, how jurisdictional modifications should be considered, how jurisdictions can think about additional disclosure requirements that go beyond the information that's required by ISSB standards in order to meet the information needs from investors, perhaps to suit the needs of other stakeholders or to pursue specific policy objectives in the jurisdiction. What are the suitable placement for disclosures in accordance with ISSB standards? So moving specifically into some of those, an important one is certainly to what extent the jurisdictional requirements, the regulatory framework that a jurisdiction will put together, to what extent it will fully transpose ISSB standards, and if it's not fully transposed, and we covered before different mechanisms to get there, the degree of alignment of the local standards with ISSB standards. As we noted in our earlier sessions, the IFRS Foundation has been focusing very much on the outcomes of the regulatory framework, whether what we consider to be primary users of general purpose financial reports will receive through the disclosures by issuers, by preparers, by banks, by corporations, the same level of information in order to support their decision making. So that's a very critical feature, and we'll be covering that today. Another one is, of course, we are cognizant that many of you operating in different jurisdictions will be looking into your specific jurisdictional circumstances, and that will probably factor into how you approach the degree of alignment, whether some of this will be temporary, whether worst case scenario, you may be considering some permanent changes. And again, we have provided some definition, some characterization of what the IFRS Foundation considers as jurisdictional modifications, which are defined as changes or exemptions from requirements in ISSB standards. Those changes that go over and above what we have considered to be transition adoption reliefs, which are extension of the reliefs that are already embedded in IFRS S1 and IFRS S2. If we can go to the next slide, please. An important consideration, particularly for those jurisdictions that may be thinking of an approach that, in addition of meeting the needs of investors, intends to achieve particular objectives in terms of meeting the needs of other stakeholders or certain policy orientations, for instance, aligned with a certain taxonomy, it will be important for jurisdictions to consider whether those additional disclosure requirements that are being introduced can potentially obscure information that's required by ISSB standards in a way that hinders the ability of investors and primary users to make informed decisions on the basis of that information. And we'll be covering that again today. I won't spend too much time on dual reporting because many of you will not be considering that regime. But again, an important one, and that goes to the heart of what ISSB standards are intended to deliver. Whether those disclosures are included in general purpose financial reports and disclosed at the same time as the related financial statements. Again, the objective is for the disclosures to enable investors to make informed decisions. Being able to contrast the financial related information together with being able to assess and price sustainability related risks and opportunities. So again, those are critical considerations that we'll be getting into the details later on today. If we can move again to the slide, thank you very much, Mossy, for that. One aspect of guidance that's included in the Roadmap Development Tool, and for those of you that have had the curiosity to explore that throughout the different sessions that we've been covering, it's that a jurisdiction's adherence to the global reporting framework, to the global baseline, it's an important determinant of capital markets confidence in the capital market disclosure regime. We've been covering today that for jurisdictions to be able to assert that they are incorporating global standards, global practices, global principles, the best in class, it's important in order to raise investors' confidence in the soundness, the rigor of the regulatory framework. Again, another aspect when dealing into jurisdictional modifications is, of course, the jurisdictions need to consider, again, what are the potential implications that those jurisdictional modifications can have. Some jurisdictions may be considering addressing specific jurisdictional circumstances, but at the same time, by doing that, that may hinder, may conflict with the objectives of delivering timely, consistent, comparable information, aim to strengthen the transparency and effectiveness of their capital markets. So again, the decisions are they rest with different jurisdictions. They're sovereign to make the decisions. So we're trying to orient them as to which are the aspects that should be looking into. As we've mentioned again before, it is critical that jurisdictions, in order to meet the goals that have been set by ISSB standards, they consider whether they're meeting the information needs of investors. Let's move to the next slide, getting perhaps into the specific. So again, just trying to go back into the main structure of the Roadmap Development Tool. On top of the guidance covering some of those aspects, one important aspect is that we are raising some matters for consideration for the jurisdiction and outlining different decision points that lead to a spectrum of different outcomes. So in terms of matters for considerations, I think jurisdictions will need to determine to which extent ISSB standards will be fully incorporated into the framework, or whether a jurisdiction will decide to develop its own local standards, and to what extent these local standards will be pursuing a significant degree of alignment. As we have covered before, it's important for jurisdictions to make this decision not just on the very short-term basis, but also considering the mid and long term. As we have covered in previous sessions, our standards are intended to be informed by the markets to deliver information that's suitable for the markets. That means that our standards will likely need to evolve over time. So it's important for jurisdictions to consider how they will be addressing some of those changes. So some of the decision points that jurisdictions will need to consider is whether ISSB standards will be required versus permitted, whether the scope of the sustainability-related risks and opportunities will be initially limited to climate, or whether it will they will encompass the whole spectrum. And if a decision is made to take a climate-first approach, whether that will be a permanent modification, whether the jurisdiction has the powers or the mandate to go beyond, or whether it's just a transitional element. Again, for those jurisdictions that opt to have a domestic, a local framework, it's important to consider whether investors, whether users of general purpose financial reports will receive information that's considered to be aligned. And therefore, we came up with this terminology, whether local standards will be able to deliver functionally aligned outcomes. And I'll be covering that later on. And again, so different spectrum of outcomes that can result from the decisions that jurisdictions take, ranging from full alignment with ISSB standards, or again, local standards that are designed to deliver functionally aligned outcomes, a middle ground solution, which is climate reporting aligned with ISSB standards, or requirements that are not functionally aligned. So depending on the outcomes, it's very likely that the description of the jurisdictional approach will change, and that the final objectives in terms of meeting the policy goals of the jurisdiction will change over time. So if we can move to the next slide, trying again to address what we mean with functionally aligned outcomes. What is this terminology that the IFRS Foundation has been repeatedly using since it published the jurisdictional guide? So we consider that requirements or standards are designed to deliver functionally aligned outcomes if they provide the same information and outcomes that are useful to primary users, again, investors, in making decisions relating to providing resources to the entity. So in order to meet those goals, they need to meet the criteria that is articulated mostly in IFRS 1 around the conceptual foundations, the core content, and the general requirements. I should be saying that this determination, of course, needs to be made on a case-by-case analysis, subject to a holistic review of the different features in the local requirements. But again, importantly, the focus is really on outcomes, whether a report put aside together with a report prepared in accordance with the local requirements, local standards, put aside with a report prepared in accordance with ISSB standards, will deliver the same information that's useful to investors. We can move to the next slide. What we have tried to do in the Roadmap Development Tool, in order to provide a bit of orientation to jurisdictions, is try to determine some parameters that we believe are fundamental, that need to be incorporated into local frameworks in order to deliver the degree of alignment. And in order to help jurisdictions figure out what is it in IFRS 1 that we need to look into versus what it is in IFRS 2 that we need to look into, we've tried to split both in order to be more helpful. A fundamental one is, of course, achieving a degree of alignment when it comes to materiality. The definition of material information needs to be aligned with that in IFRS S1. And in case of local standards that include approaches that are stated to meet the needs, as I mentioned before, of other stakeholders, the definition of material information for primary users needs to be aligned with IFRS S1. That's a fundamental criteria that the jurisdictional framework needs to meet in order to be considered that it's designed to deliver functionally aligned outcomes. Building on that, as I mentioned before, one of the requirements in IFRS S1 is that information that is required to meet the needs of primary users needs to be clearly identifiable. So for those cases where jurisdictions are looking to require disclosures that are additional or incremental to those that are required by ISSB standards, there is a need, again, to have particular provisions. It needs to be particularly stated that that additional information, that incremental information, needs to be doesn't obscure information required by ISSB standards in a way that either because of its presentation, because of its volume, information required by ISSB standards is clearly identifiable and distinguishable. So again, for those jurisdictions thinking of a broader approach, these are important considerations if they're thinking of building a building blocks approach that is intended to deliver information suitable to meet the needs of other stakeholders beyond investors. Another important parameter is, again, timing, location, and reporting entity. And this has to do with one of the principles on ISSB standards, which is, again, ensuring that there's information that connects with financial reporting in a way that's useful to investors making decisions on whether to provide resources to the entity. So again, sustainability-related financial disclosures need to be provided at the same time as the financial statements, need to be included within general purpose financial reports, and need to be for the same reporting entity. So a user of information can actually contrast the sustainability-related risks and opportunities together with the financial-related information coming out from the financial statements. This is, again, one of the core parameters that need to be considered and need to be determined by different jurisdictions. When looking into the core content, those of you that have been closely monitoring developments in the ISSB space, you will be aware that both IFRS 1 as well as IFRS 2 incorporate the TCFD recommendations. So the core content, again, is part of S1 and S2, and it needs to be displayed in the local requirements or standards. Information around governance, strategy, risk management, metrics and targets needs to be embedded, needs to be required. That organizational approach of information needs to be present in the jurisdictional framework. As I mentioned before, connected information, it's another key parameter, another key feature of ISSB standards. So the requirements that are put in place need to include the information, again, that enable primary users to understand current and anticipated effects of sustainability-related risks and opportunities on the entity's business model and value chain. And in terms of scope, information needs to be required not just about risks, which perhaps in certain jurisdictions, given maybe it has started with, let's say, the prudential-related requirements has tended to be a bit of a focus, but the scope needs to cover both sustainability-related risks as well as opportunities. And again, the scope should be considering, again, the full spectrum of sustainability topics, or whether it's intended to limit its scope to climate, whether that is on a permanent basis or just as a transitional basis. Another key requirement is whether the local standards incorporate industry-specific requirements. This is such an important element. We've heard, and we continue to hear recurrently from investors, from users, that sustainability-related risks and opportunities do vary from industry to industry. And it's really critical for them to be able to have information presented along those lines. It is, again, one requirement in ISSB standards to provide information on an industry level, which entails that those local requirements need to consider, again, the disclosure of industry-specific information. And on top of that, as you are aware, in IFRS 1, there's a requirement, again, to consider the applicability of SASB standards. Again, not to apply SASB standards directly, but consider to consider the applicability of SASB standards. So again, that is one additional parameter that we will be considering when looking into jurisdictional approaches. If we can move then on into IFRS 2, I think I've covered already the materiality approach. So that applies both for IFRS 1 and for IFRS 2. Looking perhaps more specifically into GHG emissions. In order to, again, for local standards to be considered that they're designed to deliver functionally aligned outcomes, the climate-related requirements will need to include disclosures of Scope 1, Scope 2, and Scope 3 of GHG emissions. Again, that will provide perhaps some indications as to how jurisdictions should be considering the onboarding of companies or the phasing in of requirements in order to ensure that companies are ready to provide the information, but that they retain that aspiration to retain the requirements on Scope 3. Similarly, and along those lines, the consideration of the GHG protocol as the measurement framework needs to be present. So jurisdictions will have to require the use of the GHG protocol as the measurement framework for the GHG emissions, unless, of course, and this is something that's already covered in IFRS 2, unless the jurisdiction's laws and regulations require another measurement framework. Particularly relevant, I think, for financial institutions or even for those corporates that engage in financial activities, financed emissions need to be, again, incorporated into the requirements. So for entities that have activities that in the asset management, commercial banking, or insurance domains, incremental information set out in IFRS 2 around the entities category 15 needs to be considered. One important clarification is that ISSB standards do not require companies, entities to have set targets or transition plans. However, if companies do have targets, either because those are imposed by regulations or whether those are determined on a voluntary basis by companies, targets and transition plans, ISSB standards require the disclosure of those elements. And we will be looking again whether jurisdictional frameworks are considering these requirements within the scope of requirements that are being put together. Another important element is being able to enable primary users to assess the resilience of the entity's strategy and business model to climate-related changes. So again, information around scenario analysis needs to be considered as part of the framework. So I've been touching already on those aspects that we consider relevant when making a determination about whether local standards do deliver that degree of functional alignment. So again, we just wanted to share, for instance, some jurisdictional examples of how they have been thinking about those parameters. So one example, and I think this was covered as part of the sessions earlier, I think it was session 1. Brazil has certainly taken on board ISSB standards in the design and definition of the Brazilian standards. So one could actually conclude that the Brazilian standards are basically a translation into Portuguese of ISSB standards. So they have transposed ISSB standards into their framework. Another different example is the one that Australia has taken. They have actually set sustainability-related standards as well as the corresponding regulations. One of the things that they had not initially considered is the introduction of industry-specific requirements. However, they had already noted that they have initiated a project to consider those industry-related disclosures on a mandatory basis. Again, in order to meet the needs of many of the stakeholders that participated in the consultation process that raised that need. Again, another two different examples, Hong Kong, they have issued Hong Kong standards that are fully aligned with ISSB standards. And they had actually articulated a very compelling policy rationale for a jurisdiction that has, a significant capital markets that has exposure, I think, at global level. Another example is, of course, the Indonesian approach, which again, they have taken ISSB standards, translated them into their local language, and acknowledging that there were some changes that the ISSB was considering with respect to GICS, they had already put that on pause. So different considerations by jurisdictions on how they are looking into the degree of alignment. If we can move to the next one, again, jurisdictional modifications. I've been covering that one already to a certain extent. But here it's important to perhaps for all of you responsible for making some of the adoption decisions to consider, as I mentioned, the implications of modifications, whether before pursuing specific modifications, whether investors will be consulted to the extent that their information needs are being made. And again, will these modifications be pervasive for the whole set of entities that are subject to reporting requirements, or will just affect certain entities within a certain size? Are these modifications intended somehow to support the onboarding on companies, or are these intended to have a more permanent role? And again, just building from our lessons learned from the introduction of IFRS accounting standards, I think we need to be cognizant that once permanent modifications or carve-outs are being made, it is pretty challenging to go again through the regulatory process that's needed to address some of those, if those are deemed that are somehow hindering, limiting the information that investors need in order to make, again, informed decisions. So a different range of outcomes, again, from extensive modifications, which are likely going to lead into the description of the jurisdiction as partially incorporating ISSB standards, again, to limited modifications, for instance, not considering an option that's available within ISSB standards, but ensuring that the other alternative remains available. So just cutting down, stopping one of the options that's available in accordance with ISSB standards. Some of these modifications may not result in significant deviations and will still result in the jurisdiction providing the degree of alignment. And again, that is an invitation we made already in the jurisdictional guide, discouraging jurisdictions from making significant modifications. So again, no modifications, no significant modifications, again, are the ones that will really put jurisdictions in the journey towards fully adopting ISSB standards. We can move to the next slide. We can probably skip this one and move into the next one, Mossy. So I've covered already additional disclosure requirements to a certain extent. So I would like to focus perhaps on the different outcomes. Some jurisdictions that will be considering incorporating additional incremental requirements, I think they will need to look into what's really the makeup in terms of both volume and presentation, and whether these additional disclosures can come in the way of hindering investors' ability to receive material information. So again, if by volume, by the way information is being presented, the information that's material, that's required by ISSB standards is obscured, that will again, probably result in a different pathway rather than fully adopting ISSB standards. As we noted before, ISSB standards allow jurisdictions to consider a building block approach. So presentation of additional disclosures that do not obscure information but ISSB standards still allows jurisdictions to get to the point where full adoption can be considered. This is also why we had invested so much time working together with our European counterparts, the European Commission, IFRAC, in order to ensure that additional disclosures could be built together with the application of the interoperability guidance in a way that investors could receive the information they need. So these are different outcomes resulting from how jurisdictions construct the architecture of their standards in order to deliver the information needs for investors. If we can move to the next one, we can skip this one, Mossy, and again, look into placement of disclosures. Again, I've covered that already, but in terms of outcomes, I think we need to be clear that perhaps just a reminder that in accordance with IFRS 1, general purpose financial statements, management commentary, MD&A, sustainability-related financial disclosures, which can be contained in an entity sustainability disclosure document. So we're not being prescriptive as to the location of information, but we're being prescriptive in the sense that the information needs to be within general purpose financial reports. That's an important consideration because that is what enables investors, primary users, to make informed decisions. So again, in terms of outcomes, if that information is not within the general purpose financial reporting package, that is likely to lead to different outcomes rather than a jurisdiction fully adopting ISSB standards. Again, being silent, not being specific, will not result in that outcome. So just wanted to make very clear that this is another central determination in order for jurisdictions to bring the degree of alignment that we believe will be meeting, I think, the needs of investors. So I think we can probably pause here for a couple of questions before we move into the next session. So I'm going through the questions I'm seeing in the chat. I think there's an interesting question on samples of jurisdictions that have conducted a readiness assessment prior to the introduction of S1 and S2. And again, when we were looking into the roadmap development tool, we noted that jurisdictions will likely need to conduct a market readiness assessment. We have incorporated some jurisdictional examples and roadmaps that have been looking into market readiness that are available as part of the roadmap development tool.
I would like to ask Jonathan, with
Yes.
regards to materiality and additional disclosures, among the emerging markets, the GRI standards and the stock exchange disclosure standards are primary driver of sustainability disclosure at the moment. What do you see in the jurisdictions which already have the kind of impact reporting frameworks in place? How do they adopt ISSB standards, and where do they require companies to disclose the information?
Thank you very much, Jana, for the question. What we have seen is that those jurisdictions that have accrued significant experience in sustainability reporting on the basis of different frameworks being used, they are far more advanced and ready to be able to introduce ISSB standards, again, on a mandatory basis into the regulatory framework. Perhaps a couple of examples here. As you are aware, the IFRS Foundation has an MOU with GRI, so we're working together in order to streamline the information that's being provided in a way that is seamless. So again, trying to build from the GRI experience. And again, I should also note that IFRS S1 includes as a source of guidance in the absence of a specific sustainability disclosure standard. Again, it includes a requirement to consider the applicability of the SASB standards and also includes as an additional source of guidance the consideration of GRI standards to the extent that they can help in meet the information needs of investors. So we do understand that those are useful sources of guidance. But again, the way jurisdictions are looking into that is they're probably incorporating into their mandatory framework the ISSB standards and ensuring that those provisions that are embedded in IFRS S1 with respect to non-obscuring are clearly there, so that when a preparer thinks of integrating into a single report information in order to meet other stakeholder needs, they have clear indications and guidelines as to how they can put together or present the information that's required by ISSB standards in a way that can clearly be identified. At the end, what we are trying to avoid is investors having to navigate thousands of pages of information in order to determine information that's material for decision making. So I think we all need to be clear of what is the process that needs to be put together. So a number of jurisdictions that have significant GRI experience, and some of them, some of them are members, I think, of the SBFN, have already considered that. Jurisdictions like Malaysia, for instance, like Singapore, they have a significant GRI experience, and they have been introducing ISSB standards, again, paying attention to those parameters.
Then I have a question from my end as well.
Sure.
Thank you very much for explaining about the degree of alignment. I'm just curious, when jurisdiction introduces ISSB standard, do they also move from not aligned towards fully alignment in a phased approach? I've seen countries move from, for example, non-mandatory to mandatory in a phased approach. But I'm also curious if there's a case in terms of degree of alignment to move up that gradual alignment in a phased approach.
Yeah, thank you, Teko, for the question. And I think we'll certainly be hearing probably later on, I think, from Turkey and Chile on the approach that they have taken. So one of the things we had highlighted in the jurisdictional guide is, again, how jurisdictions could actually phase in requirements as well as scale requirements. Phasing in requirements is in light of the question that we were addressing before, in light of the market readiness, the maturity of the market participants in the ecosystem, what is the pace of introduction of requirements? And we have seen that in jurisdictions have started incorporating not the entire set of requirements in ISSB standards, but perhaps extending their transition reliefs. And again, if you ask me, one of the reasons why the ISSB incorporated elements around proportionality and transition reliefs is precisely to help the onboarding, I think, of companies. So when we are asked directly by jurisdictions, what's the suitable approach? Rather than introducing, let's say, changes to the framework, is again, consider whether the extensions of transition reliefs, and I think Mosi will be covering that later on, is a suitable way to facilitate that. That together with that sort of scalability considerations, whether we should be thinking initially of a subset of the larger entities in order to trickle down then to cover a wider range of entities. So it's probably both the phasing in of requirements together with the scalability that can address some of the market needs. Again, we have been focusing mostly on the jurisdictional target. We do understand that some jurisdictions will be initially permitting the use of ISSB standards to develop some market readiness. Some may potentially be partially incorporating ISSB standards, so not even the entire extension of ISSB standards, but they have set a goal and they have provided clear milestones as to how the requirements will kick in so that preparers can get ready for the entire set of disclosure requirements. So again, it's important to navigate the process and to set clear milestones and the jurisdictional ambition in order to meet those goals.
Great, thank you very much, Jonathan.
I think there's an interesting question on the challenges in African markets. And for those of you that can go back probably to session number 1, you may recall that we provided a bit of a jurisdictional landscape as to what is really the global progress. And one of the things that was interesting, and I do believe I commented on that, was, why African jurisdictions were actually coming at pace with respect to the adoption of ISSB standards. It is true as well that most jurisdictions in the African continent have been considering roadmaps that encompass a few years. So for instance, Nigeria has permitted the use of ISSB standards as of 2024, but will be mandating ISSB standards in 2028. So they have allowed that interim period in order to build market readiness, in order to ensure there's capacity building to support entities there. But there are other jurisdictions. I think Rwanda, has issued a roadmap. Kenya, Uganda, Tanzania. So it's rather a phenomenon that African jurisdictions are actually on the forefront of the adoption of ISSB standards, particularly because they do understand what is the value that ISSB standards can bring to strengthen their capital markets and make their capital markets more attractive to foreign direct investment. Probably in the interest of time, we should be moving into the second section, but we will have another placeholder for Q&A, and maybe we can touch on some of these questions later on. But let me perhaps pass on, I think, the baton to my colleague, Mosi Relitsi, to cover readiness. Mosi.
Thank you very much, Jonathan. So starting on that point of market readiness, here we look at the fourth part of the wheel, which is actually when. When should the sustainability-related disclosure requirements be applied? And under that, we have both the application date as well as the transition reliefs that would be considered by the jurisdictions as they introduce sustainability-related disclosure requirements in their ecosystem. So this is the last part of the four wheel. The first one, as we said, was the how, and then we went into the who. We just finished with the what, which Jonathan just covered, and then this part then is when. And here we're basically looking at two aspects, as I've already indicated. One of which is the effective date, that is the date when the requirements would be required to be applied within a jurisdiction. And then the next one is the transition reliefs, that is the extent to which the jurisdiction actually extends the existing standard transition standard reliefs already existing in the standard. Earlier on, we did talk about the jurisdictional modifications. So for this part, what we are considering is basically the extension of the existing transitional reliefs, because anything more than that, we are saying that will qualify as jurisdictional modifications. We do take note of the fact that different markets, different jurisdictions are at different levels in terms of readiness as far as application of sustainability-related disclosure requirements is concerned. So some are still actually coming into learning the requirements, coming into learning the subject matter of sustainability reporting. And in this instance, then we are saying when actually deliberating on introduction of sustainability-related disclosure requirements, it is imperative to look at their market readiness. Looking at market readiness actually requires considering the familiarity in the ecosystem around sustainability-related reporting. We just had a question regarding how jurisdictions are approaching instances where they already have voluntary standards or frameworks. That can actually assist, as Jonathan indicated, jurisdictions to speed and actually be able to comply with the ISSB standards, because those jurisdictions are already familiar with the subject matter of sustainability related reporting. But in that notwithstanding, some jurisdictions would not have had the chance to actually have those voluntary standards or ecosystem at play in their ecosystem, and therefore that also should be taken into consideration. And then with that in mind, what should be considered is the issue of scaling and phasing, which Jonathan just mentioned moments ago. And this part is where we are considering whether the jurisdiction is going to require certain requirements for certain entities at different times. Are we going to apply the requirements all at the same time across the different market players, or is the jurisdiction going to phase in the entities, for example, start with listed entities and then eventually bring in large entities and then eventually move to other parts of the economy? Or is the jurisdiction going to rather phase in the requirements, that is, start with certain aspects of the requirements in the ISSB standards, bringing them in over a number of reporting periods? So that's one of the things that should be considered, as well as when talking about market readiness, the capacity, the knowledge base, the expertise, the resources, as well as the technology that is available within the corporate reporting system for the reporting entities to actually be able to deliver decision useful, high-quality decision useful sustainability-related financial disclosures. Of course, if we are to vary the reporting dates, or rather the effective dates or the application dates, what comes with that is delayed availability of comparability to the sustainability related information for the use by the investors. But then that has to be balanced with actually ensuring that the information that is being presented to investors is of high quality. And therefore, while there may be a delay by virtue of the jurisdiction making a decision to delay while in the meantime building capacity, that is balances with the investors later on receiving that high quality data in terms of sustainability related disclosures. So we do have specific reliefs in the standards for certain aspects. So here we have, for example, the reasonable and supportable information that is available at the reporting date without undue cost or effort. We also have skills, capabilities, resources available to the entity. So these were there to address a concern that was raised by the market when responding to the exposure drafts to say there is limited amount of skill, there's limited amount of information available for us as the system or as the reporters to be able to make those disclosures. And in responding, then the board made that decision to say, let's then include these reliefs in the standards. So these reliefs are different from the transition standard reliefs because these ones would be ongoing to say when reporting, the jurisdiction, the entity has to take into consideration reasonable and supportable information that is available at the reporting date without undue cost or effort. But of course, taking into account that over time, the entity will be building data, the entity will be building the skills to be able to meet the reporting requirements. And then in the standards themselves, IFRS S1 and S2 have embedded the transition standard reliefs, which are available to all entities when they first apply the IFRS S1 and the S2. So we should take those as different from the proportionality reliefs that will be ongoing, and then separating that from these ones which are only available in the first year of application of the IFRS S1 and S2. So in considering these, the jurisdiction would consider whether they are going to allow them to, these reliefs to operate as they are, or if they are going to extend. If extending, then from the IFRS point of view, in terms of considering the jurisdictional approach, we'll be considering whether those are limited to climate first reporting, to the timing of reporting, to the greenhouse gas protocol, or the transition standard relief on scope 3 GHG emissions. We did note that when these are extended, then they will be identified as transition adoption reliefs. But anything over and above these or over and above a certain period of time, then will be considered to be jurisdictional modification. So this are what we consider when we basically look at the market readiness on the aspects of effective date as well as the transition reliefs. And to put that into perspective, when we look at the effective date, of course, this effective date basically refers to the requirements when the date when the requirements become effective within the jurisdiction, rather than the effective date as stipulated in the standards. Because you know right now at the moment, we already have an effective date in the standards. But as far as the roadmap development tool and the jurisdictional guide are concerned, reference here to effective dates is for the date when the requirements will become effective within the jurisdiction. So a jurisdiction would need to determine the date when the sustainability related requirement will actually be applied within the jurisdiction. taking into consideration the market readiness, the available resources, the expertise. When is the ideal date for the sustainability-related disclosure requirements to be mandated? And that is done not as an isolation, but is done in consideration as well with the compliance basis to say, if we are to start immediately, are we going to be permitting or are we going to be making it mandatory? If we are going to delay until, say, 2028 or 2027, are we going to be permitting in the meantime? So we consider all this in wholesale. And then one of the other things that has to be considered is the extent to which the requirements effective in the jurisdiction would align to the disclosure requirements in ISSB standards, that is IFRS S1 and S2 at the moment. That is, if we are bringing in the requirements not relating to the standards, are they aligned to the ISSB standards? If not aligned, are they functionally aligned as meeting the criteria that was shared earlier on? And if they are outside the transition standard reliefs, then you have to consider as well the implication as far as producing or providing comparable, consistent, sustainability-related information is concerned. And then the last part in that regard, of course, is whether one or several of the requirements in the ISSB standards will be delayed beyond the effective date prescribed by the ISSB standards. So here it is to consider whether the jurisdiction for the subsequent ISSB standards, or the future ISSB standards, the jurisdiction will actually adopt them on a case-by-case basis and determining effective dates, or whether they will actually take the dates as already proposed by the ISSB standards. We have noted that in some jurisdictions, the standards that are actually proposed for adoption are IFRS S1 and IFRS S2. And these jurisdictions are saying when the ISSB issues new standards, we will consider those for adoption. Some are adopting the current IFRS S1 and IFRS S2 and all future ISSB standards. So these are all the considerations, some of the considerations that can be made as far as the effective date is concerned. Of course, also including the extent, the amount of time that it takes between the time when the entity or the jurisdiction issues a roadmap and when the requirements are actually applied. So in so saying, the outcomes would differ based on that. So the first one here is whether the requirements are actually effective or will be effective within 1 year of issuing a roadmap, or they are effective later than 1 year but before 2029, or if they are effective beyond 2029. So the ideal will be when they are already effective or effective within 1 year, but later than that, then the jurisdiction will take into consideration what works best given the circumstances that they have in that jurisdiction. So we have different jurisdictions that have considered different effective dates. Turkey will share in detail what they have in their jurisdiction, but we know that they are, for those jurisdictions, for these entities that actually meet the thresholds for publicly accountable entities, the effective date has been proposed to be the 1st of January 2024, and then with Brazil actually permitting for 2024 and 2025 and making it mandatory for publicly accountable entities from the 1st of January 2026. Uganda, they are currently proposing for specific entities that meet specific criteria to actually commence mandatory reporting from the 1st of January 2029. So these are just some of the examples that have actually that show the transition from point in time to the target, where they start with voluntary through to mandatory. And then in terms of transition reliefs, the deliberations within the jurisdiction, of course, have to be alongside whether the intention is to limit the transition standard reliefs to what is sitting in the standards, or rather to extend some of the transition reliefs in the standards. So what we have seen in some of the jurisdictions, they have actually taken the transition standard reliefs as they are, but some have extended the scope 3 relief to say you can disclose, you can not disclose in the first year and then also in the second year. Some have just said, okay, you can only start disclosing in the third year. So that is some of the consideration that we need to be taken into account, and as well as whether the reliefs actually are modifying the requirements of the ISSB standard, in which case, as I've already indicated, that will move to jurisdictional modifications. Some we have seen that with the recently published Rwanda roadmap, you see that in the first years, they are introducing reliefs that qualify to be, for instance, from the requirements of the ISSB standards, but they build a case, they build a momentum towards ensuring that later on they now comply with the entities will be required to adopt the full ISSB standards. So the decision areas then in these areas with whether the local requirements will include transition standard reliefs. If the transition standard reliefs, will they be extended for longer than provided in both IFRS S1 and S2? And with that, then we are saying if a jurisdiction requires only transition or permits only transitional standard reliefs, then that is an ideal situation. But if they are extended for just more than a year, but not longer than 3 years, that can be identified as a limited extension of transition standard reliefs. But then beyond 3 years, but not longer than 5 years, we are saying that one can be identified as long extension of transition standard reliefs, and then any other, then it becomes additional reliefs and extensions. So these are some of the considerations that will have to be made in terms of the transition standard reliefs. So we do have different examples. We talked about Brazil. Brazil, they propose transition reliefs as per the ISSB standards, mandating the CBPS standard. Turkey, they will share their story, but they do have an additional year relief from scope 3. And then Sri Lanka, they have a 2-year relief on reporting, providing quantitative information on determining anticipated financial effects, and then the 1-year relief from scope 3 and GHG emissions, and then 2-year relief from scenario analysis. And Canada as well, they have 1-year relief on sustainability matters beyond climate. They have 2-year reliefs on reporting scope 3 GHG emissions. They have 2-year reliefs on only quantitative aspects of scenario analysis. So these are just some of the jurisdictional examples as far as transition reliefs are concerned. So closing this part with further considerations, the jurisdiction will want to consider further elements as far as the corporate reporting ecosystem is concerned. So some of these considerations will cover assurance, supervision and enforcement, digital reporting, capacity building to support implementation. We did indicate that between the time when the jurisdiction actually says we have finalized our approach and then the time when the requirements will come into effect, during that time, the jurisdiction would want to be building expertise through capacity building, and that's where the roles and responsibilities of different market players come in, such as the training providers, the professional accountancy organizations, the academic institutions, to ensure that they train the entire ecosystem from the preparers through to the assurance providers, as well as the different data aggregators in the market. And the other part that has to be considered is the assurance provisions. That is, what will be the requirements in terms of assurance for the sustainability related financial information? Would the existing legislation or legislative requirement apply to sustainability related disclosure requirements, or will different mechanisms be applied for assurance? What would be the level of assurance that would be required for the sustainability related disclosure requirements? Well, we're going to start with limited assurance and later on transition to reasonable assurance, or are we going to see an instance where only certain aspects of the sustainability related information are required to be assured? So these are some of the considerations. We have seen different instances in different roadmaps where the jurisdictions actually start with limited, with voluntary assurance, later on limited assurance, and then later on reasonable. Some actually start with only certain aspects of sustainability related information and later on move to limited assurance on all sustainability related disclosure requirements. And then of course supervision in terms of whether the jurisdictions will actually now need to consider whether the existing supervision will apply, or they will need to come up with a new enforcement body to apply to enforce the sustainability related disclosure requirements. So with that, we can take questions, or alternatively, I can hand over to Jonathan to run through looking ahead, and then we can take all the questions and answers at the same time.
Just very quickly, and I'm cognizant of time, so maybe we can just skip a couple of slides, just to give a sense of, what's really coming next. So let's move into the next one, please. Just some of the projects we have in our toolkit. And again, just noting that I would invite members to go through the 3 sessions, because of course we've been covering today 3 pillars, but this needs to be put in the context of the other pillars that we have actually worked at. And again, an invitation for people to connect with the Roadmap Development Tool to see how all of this comes together and actually explore the usefulness of the tool, coming up with the considerations and contrasting against the different pathways that we had set. So again, hoping that this will address some of the questions that have come up. Our plan is again to publish a first set of jurisdictional profiles fairly soon. That information is coming up, and I hope that will be a useful resource again for jurisdictions trying to benchmark themselves against what others have been doing in this space. In order to address some of the questions that have been raised in order to assess market readiness, we are working on some policy rational materials. We will be putting out a policy rational paper together with the module that we plan to incorporate into the Roadmap Development Tool, as well as some market readiness tools, precisely to support how jurisdictions can actually assess to what extent, what is the pace they should be following for the introduction, I think, of requirements. And again, working out on some of the other resources that we had already outlined. So we continue to do some work, again, with the view to support you, and particularly jurisdictions in growth and emerging markets, move ahead with your considerations. But again, I'm sure you're all willing and eager to hear about the experiences in Chile and Turkey. So let me turn back perhaps to Jana, and we can cover some questions perhaps at the end.
Jonathan, over to you, Jana.
Thank you very much. Well, I would just like to give a word to our speakers, either Golsha or Bernardita, to kick us off with the experience.
I can move on, Yana, if you
Thank you,
wish.
Golsha.
Could you please open my slides, because
We can see the slides now.
Okay, thank you. Good afternoon from Ankara, everyone. It's a great pleasure to be here today. I would like to begin by thanking the organizers for hosting this important webinar. As you may know, Turkey is the first country to introduce a mandatory application of IFRS standards, mandatory in Turkey, and also mandatory assurance of these reports. We carry both the pride of this achievement and the responsibility it entails. If you wish, let's begin the presentation and we can address the details as we move forward. Looking at the content of the presentation, I'd like to start with a brief introduction of Public Oversight, Accounting and Auditing Standards Authority. From now on, I will use KGK. Then we will close the examine today's main topic, sustainability reporting and assurance audits in the context of Turkey's practices. We can move on to the next slide, please. Thank you. Very briefly, if I were to mention the responsibilities of KGK, KGK has four main functions: standard setting, authorization, inspections and investigations, and enforcement. KGK sets and issues accounting, auditing, and sustainability reporting standards to strengthen the reliability of financial statements, reports, and audits of financial statements for investors and other stakeholders. Registration with the KGK is a fundamental requirement for auditors and audit firms. And also KGK's inspections and investigations play a vital role in this, ensuring that audit firms and auditors adhere to the highest standards of quality and compliance also. This function is critical for maintaining investor confidence. And KGK's enforcement functions is designed to uphold the integrity of financial and sustainability audits in Turkey by ensuring strict compliance with applicable regulations and standards. Can we move on, please? Today we will take a closer look at sustainability reporting and assurance audits. We can move on to the next slide. Let's dive into the relevant concepts, EU and Turkish regulations on sustainability and KGK's role in these processes. And last of all, I'll introduce you the KGK's capacity building program. Can we move on? Okay. The EU, European Union, is our largest export market and therefore a key actor shaping the direction of our national regulations. In particular, the Corporate Sustainability Reporting Directive adopted by European Commission is undoubtedly one of the most striking developments in sustainability reporting. With this regulation, EU improved its sustainability reporting in terms of both scope and content, and made it compatible with its macro policies on sustainability. Although there has been some slowdown due to the omnibus package, but the final destination remains unchanged, I believe. If you consider Turkey, developments such as becoming a party to Paris Climate Agreement, the preparation of the Green Deal Action Plan, are indicators of our country's attitude towards going parallel with the world regarding sustainability. KGK, which is the competent authority on financial reporting, started a rapid work to eliminate the deficiency in the field of sustainability reporting. Can we move on, please? CSRD represents a significant shift in how companies are expected to disclose their ESG impacts. When we look at the CSRD, it's clear that Europe is leading the charge in standardizing sustainability disclosures. In contrast, Turkey has been aligning itself with these developments, but with some regional adaptations. KGK has issued Turkish sustainability reporting standards, which are compliant with ISSB standards. Approximately 400 Turkish companies fall under the mandatory sustainability reporting requirements. Unlike the EU's double materiality approach, Turkey follows a financial materiality lens, focusing more on the financial impact of sustainability risks on businesses. As sustainability reporting becomes more entrenched in both EU and Turkish regulations, it's clear that businesses must adapt a forward-thinking approach. Whether in the form of EU CSRD or Turkey's TSRs, companies must embrace sustainability as a core aspect of their operational and financial strategies to remain competitive in an increasingly sustainability-driven world. Can we move on, please? Because of our time, I rush a bit. I may briefly say that our goal is to place sustainability reporting on the same basis as financial reporting, which has the same impact and importance as financial statements in determining corporate value by increasing trust, comparability, and transparency is sustainability reporting. Why do we care so much about this? Because in order for businesses to continue creating value by continuing their activities effectively in the long term, they need to transparently reveal their contributions to corporate sustainability and their negative impacts and develop new strategies by analyzing their risks and opportunities. Can we move on to the next slide, please? Also, assurance engagements are essential in building trust in sustainability reports. For 2024 reports, Turkey introduced mandatory assurance engagements in line with global best practices. This would be done under ISAE 3000 and 3410, which set the standards for assurance engagements related to non-financial and climate-related disclosures. KGK will also oversee this assurance process, ensuring that all engagements are conducted in line with the international standards. And finally, I'm pleased to announce that we successfully conducted 4 sustainability assurance auditor examinations in 8 months. This marks a significant step forward in ensuring the quality and reliability of sustainability reporting in Turkey. We are excited about the future as we continue to build on this foundation. Can we move on to the next slide, please? And last of all, I want to talk about the capacity building program of Turkey, which is an initiative developed by the KGK to ensure the successful implementation of sustainability reporting in Turkey. This program is built on 5 key pillars, which I will outline now. The first pillar is awareness and collaboration and focuses on raising awareness about sustainability reporting among businesses and also public institutions and private institutions also. This includes holding workshops, collaborating events, joining events, etc. And I can say that in 1.5 years, KGK has joined and contributed more than 140 events and reached directly to more than 21,000 people directly. This is an amazing number, as you might appreciate. And I can give also an example that on June 16 and 17, we will organize a 2-day workshop by dividing all companies subject to mandatory reporting into 2 groups and gathering all their relevant stuff. This will also allow us to observe the level of readiness firsthand and to reiterate the fundamental requirements. Through direct engagement, we aim to address their questions and concerns individually. Second pillar is a training curriculum and accreditation. This involves the creation of a comprehensive training curriculum on sustainability reporting, tailored to financial materiality-based reporting. Up to now, KGK has accredited 7 institutions and lots of people has been trained up to now. And the third pillar is a green collar competence program. And this program addresses the need for green collar workers who are competent in sustainability reporting. Just as the demand for sustainability reporting professionals grows globally, Turkey is also experiencing a gap in this area. And this program aims to close this gap by training individuals who can support businesses in their sustainability reporting efforts. And the fourth pillar includes assurance and oversight system. I mentioned our assurance a bit, but I can say that this includes continuous monitoring of auditors' work and ensuring they meet the established standards for sustainability assurance. And the last pillar is also an inevitable one, the digitalization. As the 5th pillar of our program, digitalization focuses on integrating technology into sustainability reporting and assurance processes. This includes developing digital reporting infrastructure, enhancing data interoperability, and leveraging analytic tools to support effective oversight and comparability. We see digitalization not just as a support function, but as a strategic enabler of scale, quality, and transparency in sustainability disclosures. In this program, we have outlined both the short-term and long-term goals for each pillar. Since the program's inception last year, we have been actively working on achieving these objectives, and I'm pleased to report that we have received very positive feedback from both businesses and public stakeholders. And this year, the first reports have started to be published. Although the number is still limited, we expect most of them to be finalized by mid-August. With the transition relief also. Initial observations reveal that institutional capacity and the level of preparedness are key factors in determining the quality of reporting. Some companies have grasped the conceptual framework of the TSRs and produced disclosures integrated with their business models. However, I think the most challenging parts are the value chain analysis and a lack of sufficient connectivity between sustainability disclosures and financial disclosures. This overall picture indicates that materiality assessment, data responsibility, and governance ownership remains areas with significant room for improvement. Still, we recognize the challenges of being the first. We also see and appreciate the significant effort that has been invested. The fact that the standards have been embraced to this extent in the very first year is encouraging for us and signals that substantial progress will be made in coming years. So in conclusion, sustainability reporting is no longer a secondary concern for businesses, but an essential component of their financial reporting framework. I hope I'm in my time, and thank you for your attention. I would be happy to take any questions you may have.
Very much, Gosha. In the interest of time, I would like to hand over to Bernadita for presentation. And sorry, everyone, I think we need to run over a little bit. So hopefully you can stay until the rest of the presentation and the session. Thank you.
You're welcome.
Thank you very much for the invitation. I will share my presentation. Okay.
Yes, we can see your screen. Thank you.
Okay, thank you very much. Here is. Okay, the Financial Market Commission is the integrated regulator and supervisor of the financial system in Chile. We oversee the banks, insurance companies, and the security markets, among others, financial institutions. Our objectives are the market conduct, financial stability, and market development. In this sense, climate change and sustainability issues entail risk for financial institutions and investors, and that's why we deal with these issues in issuing a general rule in order to inform the investor about the risks and opportunities related to the ESG matters. This process started in 2015. The CMF issued 2 norms related to corporate governance and sustainability issues. Those norms were deal with the corporate governance issue in a form of the comply or explain, and the other one, the other general rule, asks for different indicators related to the board and employee diversity and gender wage gap. In 2019, we started a process to issue a more complete rule that we call the General Rule 461, we started at the end of this year with a publication of a public document. We wanted to know the observation and suggestion of the private sector. Then the pandemic started, so we had to postpone the publication of this norm, but we performed or made another public consultation in the first quarter of March 2021. And after this consultation, we work with the private sector in different workshops in order to understand their suggestion, observation, and worries about the future rule. And at the end of the 2021, we published our rule that we are going to talk ahead. I want to mention that the local market really appreciate this initiative. They wanted to have a standard related to the ESG matters. The investor wants information from the companies related to these matters. So we published at the end of 2021 the General Rule 461. This rule required to the companies to disclose information related to the climate change and sustainability issues, and also corporate governance. This rule was based in the different standards that were available in this time, and we follow the TCFD standard, and also we incorporate the SASB standard. The company has to inform the SASB indicator in the annual report. The objective of this regulation was to give more information to the investor, improve the reputation of the companies, decrease cost, decrease risk, all of them that will contribute to attract more investors. After the publication of our rule in 2023, ISSB published its standards 1 and 2, and given that we have incorporated SASB in our node, we decided to converge to the ISSB standard in 2027. Why we decide that? Because in 2023 there was the international reference standard, and JOSCO endorsed those standards. Given that we have started with a rule we have our general rule with SASB standard in 2021, we think that our companies are prepared to comply with the IFRS standard in a better way. Also, we introduced some transition periods in order to comply with the standard, and we defer the effective date of implementation of the IFRS standard. How does this work in Chile? Well, there is some which companies are mandated to comply with the rule are the publicly traded corporations, the security issuers. The biggest one, there is an exception that those security issues with consolidated assets are less than $40 million, they don't have to comply with the rule. They can do it in voluntary form, but it's not an obligation. Banks and insurance companies has to comply with the rule. Asset management firms, the financial market infrastructure, and state-owned companies have to comply with the rule. Partly, there is an exception related to the information of the SASB indicator, and in 2027, the IFRS S1, S2 indicators. And there are other companies that can inform voluntary the ESG standards or information. We introduced a phase-in period. In 2022, there is a voluntary reporting. In 2023, the companies whose consolidated assets are higher than $800 million must comply with the norm. In 2024, the public companies that have assets higher than $40 million they have to comply with the norm. In 2026, the rest of the other security issuers and the financial institution that I have mentioned has to comply with the norm. And in 2027, the annual report that is going to be published in 2027 has to comply with the IFRS standards S1 and S2. So this is a gradual implementation schedule. In 2024, all the companies that has to report as fulfill with the requirement, and also there were 27 companies that report voluntarily. We have seen some challenges in the reporting related to the quality of information and related to the length of the annual report. Sometimes it's very difficult for us and for investors to find out the ESG information. Of course, there are some issues related to the quality of the data, and related to the assurance. We introduced a change in the last year that we are not mandated to have assurance, but if the company has an assurance, they have to inform that and inform who is giving that assurance. As a final remark, for the CMF, it's very important to contribute to the transparency and market development, investor protection and reputation. And we think that to give enough information and adequate information to the investor is key to have a deep financial market. And also we think that for us it's important to comply or to have access as a benchmark international standards. That's why we adopt SASB in the first period, and in the future we are going to adopt IFRS. And for us, it's very important that the companies, the board of the company, take this compromise with the ESG matters. They are the responsibles to spread the importance of the ESG matters in the companies, and to take care about the assurance and the control mechanism in order to comply with the norm. So thank you very much, and I stop here.
Thank you so much for your presentation. I think one question from my side would be, what were some of the consideration for the transition reliefs you adopted? Were they informed by market readiness assessments or the consultations with the market participants, or was it in the consultation with the IFRS Foundation or any partners that helped you develop the standards?
In the case of Chile, this was a process that we make a collaborative process with the private sector. In those public consultation and in those workshops, what they did with the private sector, we asked them what would be a phasing period adequate for the companies, and then the rule incorporate those observations.
Thank you. Golsha, how was that in the case of Turkey?
Actually, we are very close with the businesses and reporters, all the sectors, and we gained this view that we have to expand transition reliefs. Or actually, the first year's transition reliefs were very helpful for the businesses, but we made it. We extended for the second year the scope 3 exemption, and maybe we can extend the exemption of the relief of the publication date, the issuance date, as the first year. But we are very in very direct touch with all the shareholders.
Thank you.
You're welcome.
I see there was another question from the audience about the Chile and the new report in line with the IFRS S1 and S2. Will it be embedded in the existing reports, like the integrated report or sustainability report, or what is the expectation?
Expectation that there is the annual report that has to inform about the IFRS S1 and S2 standards. That this is the same report that the companies send to the CMF and the market, informing the SASB standards. So that is where they have to replace our general rule with the IFRS standards.
Does anyone from the team have any kind of follow-up questions or feedback? Because if not, we received previously a question about how to go best about implementing a roadmap when there are already certain standards in place that are being implemented, and how the jurisdiction try to incorporate those or complement those or even replace those.
Maybe can try to address that one, Jana, because I think, again, we go back to, the first pillar that we discussed around the regulatory process. We were inviting jurisdictions to consider both their existing regulations and which are the frameworks that are being referenced. In a number of instances, I think we need to acknowledge that most sustainability-related reporting has been happening on a voluntary basis. So a lot of optionality has been given. I think Bernardita was already covering how they were actually embedding TCFD and SASB standards and why it had actually facilitated the transition towards ISSB standards, because there was already a previous degree of experiences. I think one critical consideration for jurisdictions is why mandating sustainability-related disclosures? If a mandatory approach is going to be followed, what is the most suitable framework? And again, I think here I go back to some of the references that I think Gulsha and I think Bernardita have been noting around the IOSCO endorsement process and how that is intended to strengthen capital markets. And again, what is a suitable approach towards building up from the existing experience? It's not putting aside. One of the things that we have been reiterating around ISSB standards is that it has been incorporating much of the previous existing work out there, and how through the work together with GRI, we're trying to build that building blocks approach in a more comprehensive approach. So again, we need to be mindful of what are the information needs that a particular framework intends to cover, and the suitability for it to be part of a mandatory regime, which perhaps is a bit more prescriptive as to information that is to be required and that will eventually be subject to enforcement and supervision, and subject to, again, that assurance framework.
Thank you, John, very much. I think we are already 10 minutes over, and I don't want to keep everyone on this call, as I know that Bernardita, for example, is just starting her day, and many of us are still in the afternoons or evenings. So I just want to thank everyone for your participation. Thank you to the IFRS team and our speakers. But before we conclude the series, I would like to encourage everyone to share your feedback through an evaluation survey. You can either scan the QR code or click on the link in the chat. It's a good opportunity to share ideas for any future topics and webinars that you would like us to cover. For those of you who attended all 3 sessions and fill in the evaluation form, we will issue certificates of completion probably later this month. You will receive it via email and LinkedIn. And the recording of today's session and the presentation will be shared on the SBFN website and email. If you have any questions for the IFRS team or the Secretariat or IFC, I know that there's been a lot of inquiries about the technical assistance and support. Please reach out, and we will try to also address that in the follow-up email. And with that, I would just like to thank everyone for their time and for the great discussion.